Alright, let's talk about the stock market. An institution we're told is built on supply and demand, where good companies with valuable assets see their stock prices go up. It's a simple, comforting idea. Now let's talk about a company that seems to break that idea into a million tiny, confusing pieces. Asia Broadband Inc., or AABB. On paper, they look fantastic. They are a real mining company, not some vague tech startup with a name like CloudChonk. They have massive gold and silver mining operations in Mexico, with ore stockpiles potentially worth billions, yes, billions with a B, of dollars. They're even expanding their processing plants and acquiring new, fancy technology to get more gold out of the ground. You would think, given all that tangible, shiny, actual gold, that their stock would be doing great. You would be wrong. So, very, very wrong. As of today, October 31st, 2025, AABB's stock is trading for pennies. Literally. It's the financial equivalent of finding a solid gold brick being used as a doorstop at a dollar store. It makes absolutely no sense. The company has growing production, physical assets you can stub your toe on, and a clear path to profitability. And yet, its market value is stubbornly, inexplicably, and infuriatingly low. It's like watching an Olympic weightlifter try to lift a helium balloon and fail. Something is clearly, fundamentally broken here. So, what gives? How can a company with billions in assets be valued so cheaply? The answer, it seems, lies in a dark corner of the market where the rules are more like suggestions and phantom shares haunt the trading books. The problem isn't with the company's gold, it's with its stock. A vast and dedicated base of shareholders has bought into ABB for the long haul. They've seen the assets, they've done the math, and they've decided to hold on tight. This has created a situation known as a locked float, where the vast majority of the company's publicly available shares are tucked away in accounts, not being sold or lent out. This should be a good thing, right? A sign of investor confidence. But in the upside-down world of stock market shenanigans, this loyalty has become a vulnerability. Because when there are very few real shares available to trade, certain unscrupulous actors have found a way to create their own. They are essentially counterfeiting shares, flooding the market with fakes that drive down the price of the real ones. It's a complex and infuriating scheme that punishes the very people who believe in the company the most, turning their steadfastness into an opportunity for exploitation, and it's happening on an industrial scale. Now, how exactly do you counterfeit a stock? You can't just fire up a printer and start making share certificates. The trick is far more insidious and goes by the name naked short selling. Let's break this down. Regular legal short selling is when a trader borrows a share they don't own, sells it, and hopes the price goes down so they can buy it back cheaper, return the borrowed share, and pocket the difference. The key word there is borrow. You have to actually locate and borrow a real share from someone before you can sell it. It's like selling your neighbor's lawnmower, but only after you've gotten their permission and have it in your hands. Naked short selling is when a trader skips that crucial step. They sell a share they haven't borrowed and in fact have no ability to borrow. They just sell it. Poof. A share appears on the market out of thin air, created by a simple keystroke. They are selling a promise, an IOU for a share they don't have. For ABB with its locked float, there are hardly any shares available to borrow legally. We're talking less than 1% of the total. Yet millions of shares are being shorted every single day. This is the equivalent of a library with only 10 copies of a book, but somehow 1,000 people have checked it out. It's mathematically impossible, yet it's happening. This creates what are known as phantom or synthetic shares. Estimates suggest there could be an extra 15 billion, or even more, of these fake AABB shares circulating in the market, completely overwhelming the legitimate 4.66 billion shares that actually exist. This massive, artificial supply smothers any positive price movement. Every time good news comes out and real investors start buying, this wall of phantom shares is sold into the market, pushing the price right back down. It's a rigged game where one side can conjure an infinite number of game pieces out of nothing, ensuring they can never lose. The proof of this chicanery is in something called fails to deliver, or FTDs. When you sell a stock, you have 2 days to deliver the actual share to the buyer. When a naked short seller can't find a real share to buy to close their position, they fail to deliver. Records show that AABB has had millions upon millions of these FTDs pile up over the past year. This is the smoking gun. It's a record of every time a seller sold something they didn't have and couldn't get. It's a paper trail of phantom shares, proving that the market is being flooded with IOUs that are never settled. To make this even clearer, let's go back to our library analogy. Imagine AABB is a library that owns 4,000 rare books, the real shares. About 3,000 of those books are owned by collectors who have locked them in a vault and refuse to lend them out. The locked float. So, there are only 1,000 books available for the public to borrow and read. Now imagine a shady character, let's call him a market maker, stands outside the library and starts selling borrowing slips for these books. He doesn't actually have the books, he's just selling a piece of paper that says, "I owe you one rare book." He sells 15,000 of these IOUs. Suddenly, the market thinks there are 19,000 of these books in circulation, not 4,000. The perceived value of each book plummets because everyone thinks they are common. The collectors who own the real books watch in horror as the value of their prized possessions craters, even though their books are still just as rare and valuable as they always were. This is precisely what's happening to AABB shareholders. Their real, asset-backed shares are being devalued by a deluge of fake, computer-generated IOUs that have no underlying asset whatsoever. But it gets worse. These manipulators have developed a high-tech way to hide their tracks using a process some call the recycling loop. Using high-frequency trading algorithms, they can sell a naked short in the morning and then cover that illegal sale by executing another naked short sale later in the day. The IOU is passed from one hand to another so quickly that it never stays in one place long enough to trigger major alarms. It's like a game of hot potato with a phantom potato. They can allegedly turn one single illegal naked short into dozens of synthetic trades in a single day, creating massive downward pressure while making their net short position look deceptively small. Faced with this overwhelming evidence, Asia Broadband is not taking it lying down. The company is in the final stages of filing a federal lawsuit against the market participants and online platforms it believes are responsible for this manipulation. They are fighting back, not just for their own sake, but for their thousands of loyal shareholders who have had the value of their investment systematically destroyed. They are taking their mountain of evidence, the locked float data, the impossible short volume, the persistent fails to deliver, to court, demanding that the people running this IOU factory be held accountable for their actions. The story of Asia Broadband is not just an isolated tale of one company's misfortune. It is a glaring symptom of a much larger disease infecting our financial markets, particularly the over-the-counter market where many smaller developing companies live. AABB is just one of potentially hundreds of companies being suffocated by this exact same playbook of naked short selling and phantom share creation. This isn't a bug in the system, it's a feature that market manipulators have learned to exploit for immense profit, at the direct expense of regular investors and the health of innovative companies. This systemic fraud undermines the very foundation of a fair and transparent market. It disconnects a company's stock price from its fundamental value, making a mockery of due diligence and long-term investing. Why should a company bother discovering billions in gold if its reward is to have its stock price pummeled into dust by traders who create shares from nothing? This creates a crisis of confidence. If the game is this blatantly rigged, why would anyone want to invest in emerging companies? The result is that capital is choked off from the businesses that need it most, stifling innovation and economic growth. The responsibility to fix this lies squarely with our regulators, primarily the Securities and Exchange Commission. The loopholes that allow naked short selling to persist, such as the market maker exemption and the failure to enforce delivery rules, must be closed. For years, petitions have been filed and alarms have been raised, yet the problem not only continues but seems to be getting worse. Regulators need to stop treating fails to deliver as a clerical issue, and start treating them as the evidence of fraud that they are. They need to conduct serious audits of trading in stocks like AABB and bring the hammer down on violators. Ultimately, this is a fight for the integrity of the entire market. It's about ensuring that a company's success is determined by its performance, not by the whims of predatory algorithms. The battle being waged by AABB and its shareholders is a crucial one. It's a demand for a level playing field, where the rules apply to everyone and where a share is an actual share, not a phantom IOU from a digital ghost. If we allow this to continue, the stock market ceases to be an engine of prosperity and becomes nothing more than a casino with loaded dice. And in that game, the house, and its cheating patrons, always wins.